Hi, welcome to the Real Estate Raw Advanced Multifamily video series. In this video program, I'm going to cover all of the same concepts that I covered in the beginner multifamily series, except we're going to go into a lot more detail, go into a lot deeper dive on some of the subjects, and I've even added in several other subjects not covered in the first course. So I want to start off with what I call the Advanced Conveyor Belt theory. This is the conveyor belt theory of real estate. All right, and so what I want to show you is the basics of how to build a real estate business, and then we're going to kind of build off of that. One of the first things that we want to start off with is our cash flow goal or our revenue goal, all right? We've got to know what it is we're trying to accomplish so that we know when we've accomplished it, right? So the first step is to understand how much money you want to create in passive revenue a month. I bet that's your number right there. $10,000. If not, then imagine it in increments of 10,000. Maybe it's 20,000, 30,000, 50,000, whatever your number is, right? This will just give us nice, simple math. So if you're looking for $10,000 a month in net passive revenue, right? Then what we have to do is to invest $1.5 million into real estate, producing an 8% cash on cash return. And you're all done. You'll get $10,000 a month. So just go ahead and write that $1.5 million check, get an 8% return, you're all finished. Right. If you don't currently have $1.5 million to invest, then this is just simply an example to show you how cash flow is actually created. And that's a very important concept. It takes equity to produce cash flow. Now, why I'm showing you these numbers right here is because if you have $1.5 million and it is producing an 8% cash on cash return, then that is $10,000 a month, because 8% of 1.5 million is 120,000. If you divide 120,000 by 12, that's 10,000 a month. Obviously prior to taxes or anything of that nature. But my point here is just to show you that it's an amount of equity invested at a rate of return that produces cash flow. If you don't have cash to invest in real estate and you're looking to create that cash, then the conveyor belt theory is going to be what shows you how to do that, right? So again, it's equity at a return equals cash flow. All right, and like I said, $10,000 a month, basic example, $1.5 million at 8%, 120 a year, that's 10 grand a month. So that's how we get that number. That's how we come to that. Obviously, if you have a deal that's producing more than 8%, you would not need a whole $1.5 million. If you have deals that are producing less than 8%, you would need more than $500,000, more than $1.5 million to produce that $10,000 a month cash flow. That is a basic formula to just give you an understanding of where cash flow comes from and how it's produced. Equity creates cash flow. No equity, no cash flow, right? So if you do not have $1.5 million or so to invest in a deal right now, then your basic concept is to create the $1.5 million that is going to go out there and produce that cash flow, right? So in the beginning, we're going to be trying to create that equity that produces cash flow. Because keep in mind that something is going to get up off that couch and go to work every day. Either you're going to get up and go to work, or the cash is going to get up and go to work. Your money is going to get up and go to work. But something's got to get up and go to work. And so if you want your money to go to work to produce cash flow, then we need this equity. We need that $1.5 million worth of equity, or so much equity that it would create the amount of cash flow that we're after. So that's my only point here. I'm not really trying to show you the actual get-rich formula or anything of that nature. It's just to show you that we must have equity to produce cash flow. A lot of times people want to get into the argument, do we want appreciation or cash flow, or equity or cash flow? No, you have to have all of it, is my point. And through this series, I'm going to really show you that point repeated itself. So again, equity equals cash flow, no equity, no cash flow. So equity is where the business starts. Now, how do we go out and create the $1.5 million that is going to go to work for us to produce that 8% cash on cash? That is the point of this entire video course, is to show you how to create that $1.5 million so that it goes to work and you don't have to go to work. Now, this is a theory that I've created. This is called the conveyor belt theory, all right? And what I want to show you is how a basic business model is created in the real estate business, why we do it, and how we ultimately produce that $1.5 million worth of equity that's gonna go out there and go to work for us. So first thing, I want you to imagine a conveyor belt, just like any kind of conveyor belt in a factory, widget factory or something like that, right? Standard belt there. All right, our conveyor belt is 5 years long, okay? Why 5 years? Because that is the average hold time for a multifamily asset. I know in certain market cycles, it can be shorter than that. Some market cycles, it can be longer than that. But on average, when you go out and buy a multifamily property and you want to hold it, operate it, maybe implement some value add and then have an exit strategy, a refinance, a sale, something like that. Normally you're about 5 years, just kind of a rough estimate. All right, so this is our conveyor belt. Time goes this way and our conveyor belt is 5 years long. Now, year number 1, you're gonna come out here and close your very first deal. Maybe it's a house, maybe it's a small multifamily property, something like that. This is gonna be your beginning deal here. So year number 1, we're putting our first deal on the conveyor belt. Now, keep in mind that this represents a closing. So as we're putting assets on the conveyor belt, that's a purchase, okay? So year number 1, we've done our first deal. All right, we move along. Year number 2, now we've added our second property to the conveyor belt, okay? So year number 1, year number 2, we're moving in this direction. Now we have our third year, year number 3. Now we're getting into slightly larger properties, right? Maybe we started off in houses and then we went into some small multi. Now maybe we're getting into medium-sized multi, 20, 30, maybe 50 units, things of that nature. Again, remember this is time, and as our properties are moving along the conveyor belt, this is our hold and operate window. This is us cash flowing. And so you can kind of imagine cash flow go in this direction, right? As our properties move along and we hold and operate, manage, asset manage. So here we are, year number 3, we've put our third property on there. It's getting a little bit bigger, probably getting a little bit better cash flow now. So year number 4, okay, now we've really gotten into maybe larger commercial multifamily, right? We're operating, we still have some of our beginner properties that were smaller, maybe older, lesser assets. We've been growing that portfolio over time. Assets have been getting bigger, cash flow is going up. Now, you may be, at this point in time, you might be getting acquisition fees. You might be actually producing profit to yourself in the form of fees when you close these deals. Depends on how you structure them, depends on how you fund them. But if you're out doing syndication and you're syndicating real estate, then you're probably getting a syndication fee or an acquisition fee. And that's money that you're paid at closing by your partners because you were put the deal together and raised all the capital. So we might be actually creating some cash flow right here. We're creating cash flow as the assets move along the conveyor belt, right? Year number 5 here. All right, we're all the way in 5 years. We've had all of our assets on this conveyor belt cash flowing. We're into larger multifamily now. We've got our portfolio built. We're probably getting acquisition fees at closing. And now our first property, the one that we bought in year number 1, is coming off the back of the conveyor belt. This is a liquidity event, okay? This can be a sale, this can be a refinance, anything of that nature. It's a liquidity event, an exit. Doesn't mean that we necessarily don't own the real estate anymore. For this conversation, we'll just assume this is a sale. So now you've sold this one, all right? And the idea here is that after 5 years, you've been able to fill your portfolio full. You've been able to fill this conveyor belt full of properties. Now, at each year, you're cash flowing as you operate. You're making acquisition fees as you're adding the asset to the conveyor belt. And now our first property of the 5 years is having a liquidity event. We're gonna capture equity here, all right? So the idea is that now we're gonna take this equity, the creation of this equity here from the cash flow event or from the liquidity event, and we're gonna roll that back around to the beginning, to the next purchase, all right? So we're gonna live off of our cash flow. This is what's gonna pay for our lifestyle. The equity creation, and hopefully, as this property moves along the conveyor belt, it's going up in value, right? It's appreciating. Maybe value add, maybe the market's doing good, whatever the case. So these properties are becoming worth more each year, right? Now we have the liquidity event, refinance or sale. We're gonna take that money, roll it back around. This is probably gonna be a 1031 exchange. We'll talk about that later, but that's a tax deferred exchange. And if you're not doing a 1031, then you're just still gonna reinvest the equity. The equity is what ultimately creates wealth. And through these transactions here, putting things on the conveyor belt and these liquidity events, if you take that money and roll that back around to the front, there is how you will create the $1.5 million that will ultimately create this cash flow. All right. So in the beginning, these properties may not be cash flowing that much, but as you start to add properties, you hit liquidity events, you're rolling your net worth back to the beginning, you're starting to really accumulate net worth and really accumulate some real value and maybe even legacy wealth. So the idea here is to show you that you're going to build this business and you're going to have to close and transact every year or so. But once your portfolio is built, and it may take you 3 years, it may take 5, it may take 2, who knows, depends on how hard you work. But once you've got your portfolio built, a lot of your actual money annually is going to come from here and from over here, not cash flow, right? Everybody thinks that this business is all about cash flow and we're all going to get rich on cash flow. I'm here to tell you, nobody is getting rich on cash flow. It's good. You must have cash flow. Cash flow keeps the wheels going around. It pays the investors. Cash flow allows us to go from a close to a liquidity event. That's what keeps everything running. But the real profit, the real wealth is created in the exit, right? So if you have no property, you have no exit. If you have properties, then you will have exits, sales, refinance, and ultimately create that equity. Now, here's where I'm going to go a little bit deeper. Once you get into this level, you may be syndicating real estate. You may be using partners or using other people's money to buy real estate, and that's great. But as you create more equity and your personal net worth starts to go up, you get to eliminate partners, right? So the first thing that we're going to get to eliminate is what we call sponsors, or that would be someone that comes on, brings the balance sheet, maybe helps us guarantee the mortgage. If we're over here trying to talk to a bank, they may want to see that we have a certain amount of net worth in order to close the deal. We'll cover that in the deal analysis section and in a few videos. But basically what we're talking about here is using this equity to limit the amount of partners that you actually need. First partners we're going to be getting rid of are our general partners, the ones that bring the balance sheet, the ones that bring that equity and liquidity to satisfy the lender. And as time goes on and you're creating more and more equity from each sale and more cash flow, we're going to start eliminating investors altogether, right? And if you will run this cycle for a few years, you will start to be able to build a portfolio that is yours alone and not exposed to other investors and lenders and things of that nature. If you've bought this video series or if you're watching this series to figure out how to create legacy wealth, or if you want to create wealth for generations to come, it is going to be in this model right here. And what you really can't do, what's very, very difficult to do, is to buy a property, use other people's money to buy it, such as investors and partners, and then tell them that you're going to give that property to your grandkids. You know, if you haven't ever tried to raise money by going out and telling an investor, hey, you should invest in my deal because I'm going to give you back all your money and your profit when my grandkids decide to sell the property. If you've never tried that sales pitch for raising money, give it a shot. Go tell some investors that they'll get their money back in 30 years when your grandkids sell, and let's see how many of these people want to actually invest in your deal. I'm going to bet about none, right? So the idea is that if you're syndicating and you're using partners and you're using other people's money, they're going to want to see some sort of exit. They're going to want to see that they get their money back and profit within a certain amount of years. If you are trying to create legacy wealth, that's something that you're going to need to own without as many partners and without as many investors, or none if you can absolutely help it, so that you can leave these buildings and these properties on to the next generation. And that's the conveyor belt theory. It shows you how to do it, right? We're rolling the equity forward to create our wealth. That's allowing us to purchase bigger and larger properties. They are moving along the conveyor belt. This is cash flow, liquidity event, and the cycle begins again. This, ladies and gentlemen, is what you want to leave in legacy wealth. Not this building or not this building. You want to leave this business in legacy wealth. You want to pass on this knowledge and this company to future generations, not just assets, all right? You need to leave legacy wealth in the concept of knowledge and skills, not buildings. Do you know how many people I have bought real estate from that said, hey, granddad left us this real estate. My parents left us this building. We don't know what to do with it. We're not landlords and we don't really care. Just write us a check and we'll sell you the property right now. I have bought a lot of real estate at big discounts from people that inherited legacy wealth. Not trying to be negative, but most of the time if you leave kids a bunch of real estate, they're just going to turn around and sell it as soon as you're gone, take the check and go do something else. So if you want to leave somebody something, you want to leave them education, information, not necessarily a building. So this is the conveyor belt theory of real estate. This is how a real company works. This is how it's going to work for you. Building a portfolio, cash flow, liquidity, equity, roll it around, keep that cycle going, and it'll look a little bit something like this, right? So this is your conveyor belt theory. And again, you can see where you're rolling that equity around and then the cash flow. And we're going to keep this cycle going over and over, right? This is how we're going to build our 1.5 million, 3 million, 10 million, whatever amount of equity it is that you want. Because remember, no equity, no cash flow. So what you want to do, step one, as a review, sit down and figure out how much money you need to make a month. Is it 5 grand, 10 grand, 100 grand, whatever it is. Now figure out how much equity that's going to take to produce that cash flow, and there's your goal. So if your goal is 10 grand a month, then right now your goal is to go produce $1.5 million worth of equity. And how are you going to do that? By transactions, closings, the conveyor belt theory, and these liquidity events. And this is everything else in this video series is going to be built on this concept, right? So everything else I'm going to teach you in any of my books, classes, courses, or videos is all going to be how to show you how to build and operate your own conveyor belt so that you can get started building wealth, so that you can start to reach your own cash flow goals. So stay tuned and we'll be going to some other videos here real shortly.